You know, there's this fault line running right through the market. It's a structural tension that, well, most investors can't see, but everyone can feel. And the first tremor? It starts with a single startling number.
40%. That's how much of the entire S&P 500 is now controlled by just its top 10 companies. To put that into perspective for you, we have officially surpassed the peak of the dot-com bubble. This isn't just top-heavy, okay? This is a structural imbalance the market was simply never built to withstand.
And look, it's not just us noticing. The people managing the largest pools of capital in the world are sounding the alarm. Ray Dalio's bubble indicator is flashing bright red, but he's pointing to something much deeper than just high prices. He's worried about who owns the stock and, more importantly, how they're financing it.
History gives us a pretty chilling precedent for this. Of the top 10 market darlings from the 2000 peak, only a single company, Microsoft, has managed to outperform the S&P 500 over the last 25 years. And even Microsoft went through this brutal 19-year hangover of underperformance before it ever recovered. The lesson is crystal clear. Leadership is temporary, and gravity always wins.
The takeaway here is undeniable. The easy money in big tech, it has already been made. The risk-reward has fundamentally skewed to the downside.
What we're witnessing right now is the Great Bifurcation. And this isn't just about one bubble bursting. It's about where capital has to move next. See, beneath the surface, a massive silent rotation is already underway.
This brings us to the central question, right? If capital is exiting the most crowded trade in history, where does it flow next? The answer isn't obvious, and that's precisely where the real opportunity lies.
Our entire focus here is tracking these shifts, connecting the dots right before they become obvious headlines.
The answer begins in a corner of the market that Wall Street pretty much forgot. A sector that nearly collapsed a decade ago and has spent the last 10 years quietly executing a revolution, transforming itself into a fortress that almost no one is watching, U.S. Midstream Energy. A decade ago, this industry was, well, it was addicted to debt, just burning through cash with dangerously high leverage. Today, that model has been completely flipped on its head. These companies are now self-funding, paying down debt from massive internal cash flows. They've gone from burning cash to harvesting it.
Just look at the scale of this shift. In 2018, the free cash flow per share for the Midstream Index was a measly 4 cents. By 2025, it's projected to explode to over $14. This isn't just growth. It's a complete metamorphosis of the entire business model.
Okay, now most analysis stops right here. It's cheap, it has a good yield, but that misses the real catalyst, the event that will force the market to re-rate this entire sector. We need to go deeper.
Because that financial fortress we just described is about to become the most critical piece of infrastructure for the AI revolution, not because of code, but because of physics. See, AI has an insatiable, non-negotiable demand for one thing: raw power.
Here's the physics of the problem. A traditional server rack, it draws about 7 kilowatts. A single rack of AI GPUs can draw up to 100 kilowatts. That's more than a 10-fold jump in power density. And this one fact is breaking every energy forecast and creating an existential crisis for data centers.
So how do you solve this? The grid is tapped. Wait times to connect are now 5 to 7 years. Renewables are intermittent. You can't pause an AI training model just because the wind stops blowing. Small nuclear reactors? A great idea for 2035, but not for today. That leaves one option that is scalable, reliable, and available right now.
Connecting financial markets to physical constraints. Well, that's what we do here. If you find this perspective valuable, subscribing just ensures you won't miss where we go next.
This is where the two stories collide. The rebuilt, cash-gushing midstream fortress is now positioned as the physical toll booth on the AI boom. They own the one asset that can solve the power gap, turning their pipelines into the true power lines of the digital age.
And this isn't a theory, it's already happening. Energy Transfer, that's ET, is signing deals to power data centers directly, bypassing the grid entirely. MPLX is building power plants right next to data centers to monetize natural gas that would otherwise just be flared off. Kinder Morgan, KMI, has explicitly pivoted its capital budget to serve this new power demand. And Enterprise Products, EPD, remains the ultimate toll booth on energy exports, which, by the way, underpins this whole system.
So let's quickly break down the key players. You've got MPLX, the innovator, EPD, the A-rated fortress with huge insider ownership, Energy Transfer, the aggressive growth engine cutting direct AI deals. And then there's Kinder Morgan, which is structured as a regular corporation, making it way easier for all types of funds to own. It also just happens to control 40% of all U.S. natural gas movement. 4 different companies, all converging on the exact same historic opportunity.
So the key here is that this isn't just one story. You have AI-powered demand as a brand new growth engine. You have global LNG exports providing a massive, stable baseload of demand. You have companies returning huge amounts of cash to shareholders. And you have a favorable policy environment. It's not one tailwind, it's a powerful confluence of them all.
And this brings us right back to where we started, to the question of where the real money moves next. The answer is found by looking past the intangible world of the cloud to find the alpha that's hidden in the ground. It's the ultimate picks and shovels play. During a gold rush, right? The most reliable fortunes are made by the people selling the tools. Well, AI is the digital gold rush, and these companies provide the pipes and valves, the essential energy infrastructure that makes it all possible.
And this brings us to the core insight. In a market that is obsessed with intangible code, the true structural advantage has shifted back to tangible steel. Back to the physical, irreplaceable assets that power our world.
You know, most people watch markets. We explain why they move. If you want to stay ahead of that curve, this is where the work continues.
We'll leave you with this final question to think about. What happens when a technology that is priced for absolute perfection finally collides with the hard, undeniable limits of physical reality?